Have you ever wished you could own a piece of a company like Netflix, Apple, or even MTN Ghana? Well, guess what? You actually can. And no, I'm not talking about being a billionaire investor or joining the company's board. I mean owning shares. Literally having a stake in these companies. That is what the stock market allows you to do. But how does it work? What makes stock prices go up or down? And how can you start investing? Let's break it down. Think of the stock markets like Makola markets, but instead of selling tomatoes and fabrics, companies sell shares, small ownership pieces of their businesses. When you buy a share, you become part owner of that company. That means you are not just a customer, you are an investor. Here in Ghana, we have the Ghana Stock Exchange, where companies like MTN Ghana, Total Energies, and Fan Milk are listed. But stock investing isn't just limited to Ghana. Around the world, stock exchanges like the New York Stock Exchange and Nasdaq list some of the biggest companies we are all familiar with, like Netflix, Amazon, and Microsoft. So how does it work? Companies sell shares to the public when they need extra money to grow. Instead of taking a loan, they allow people to invest in their business by buying shares. If the company grows and makes more money, the value of investors' shares increases, meaning you could sell them for a profit. But if the company struggles, your shares could lose value and you might sell them for less than you paid. When you buy a share, you are betting on the company's success. Take Netflix for example. When it first started, it was just a DVD rental service. But as streaming became more popular, its revenue grew and investors saw its potential. Demand for its stock increased and early investors made huge profits as Netflix's stock price soared. That's how the stock market works. Investors buy into companies they believe will grow. Stock prices change based on demand and supply. If everyone wants to buy a particular stock, its price goes up. If more people want to sell, the price drops. But there are some additional factors that also affect stock prices. Number one, company performance. When NVIDIA launched its AI chips, demand skyrocketed and its stock price jumped over 200% in a year, and investors saw massive profits. Number two, economic conditions. When inflation is high, people spend less, companies earn less, and stocks may fall. This happened in 2022 when interest rates went up and tech stocks, including Amazon and Tesla, dropped significantly. Number three, global events and policies. When the US placed restrictions on Chinese tech companies, stocks like Alibaba took a hit. When Elon Musk bought Twitter, now X, investors worried he was too distracted and Tesla's stock price wobbled. A lot of people think you need to be rich to start investing in stocks. Not at all. You don't need thousands of CDs to get started. Many investors start small and grow their portfolios over time. But before you jump in, here's what you need to know. Number one, do your research. Never buy a stock just because everyone is talking about it. Look at the company's history, growth potential, and financial health. Number two, think long term. Stock prices can go up or down, but good companies tend to grow over time. The best investors stay patient. Number three, diversify your investments. Don't put all your money into one stock. Spread your investments across different industries to reduce risk. Now that you understand how stocks work, how do you take action? If you're thinking about investing in stocks, you can start with an equity portfolio plan, which allows you to invest in high-growth tech companies like Apple and Amazon right from your phone. Investing isn't just for the rich, it's for you. So start small, think big, and let your money grow. Thank you for watching.